All right, everybody. How's everybody doing? Sorry, I had ran into technical difficulties there, so we're going to kind of restart the clock and start over here. So let's get rolling. So let's start this again. So welcome to the strategy room, everyone. This is basically the weekly live stream for the banker next door, where we talk about kind of all things in the world of banking. I give you guys some economic updates. I give you guys some banking news, and we kind of roll from there. So I started this live stream a few minutes ago, and I had some technical difficulties, aka a cat attacking wires, which caused a surge and caused some things to get messed up. But hopefully we're kind of back on and rolling. So I was talking about, basically I started off getting into some stuff where Jeremy Powell and the decision at the Fed, and basically Jeremy Powell is kind of he's signaled that he is basically going to start the Fed has been tightening. Now they're going to start loosening. They're going to start reducing interest rates. And basically, I gave my kind of quick take on that, saying that the Fed's got 3 more meetings for the rest of this year, basically in September. There's no meeting in October, and then they come back in November or December. I'm still of the mind that you're basically going to have a 25 basis point rate cut in September, and then the Fed is going to kind of pause and wait and see what happens. And then probably starting in January, January, February, March, and April of next year, probably going to see 25 basis point rate cuts, and the Fed is probably going to look to bring things down by probably about 150 basis points. Your federal funds rates right now are at like 5.25 to 5.5%. Probably want to bring that down to somewhere in the 4% to 4.25% range. And remember, they don't want to bring it back to zero, because then that would be what they called a ZIRP, zero interest rate policy. So they want to, they want to leave themselves some wiggle room that they can maneuver, that if things are a little worse than what they're thinking, that they can, be able to cut more if they need to, or cut deeper if they need to. Now, the other thing that I got into was, I was pointing out, and I'm going to bring this in here real quick. So this was an article. So there was a couple things that I covered this weekend in a couple other episodes. In episode 207, I covered basically this, the U.S. Treasury basically manipulating interest rates. And then in episode 208, I covered that the Bureau of Labor Statistics basically cooking the books over there with some of the numbers that they had been working on. But they acknowledged this week that that basically there was over 800,000 jobs that were stated that never worked, that basically were just made up job numbers that just went away. And of course, that makes the unemployment market look a whole lot worse than what it actually is. Now, here, again, what is happening here is that the Fed was in a restrictive tightening policy. They're reducing their balance sheet, high interest rates, basically trying to taper down on inflation. However, the Treasury has effectively been doing their own version of QE to kind of prop up the economy. And this is what I talked about in that episode. And if you want to get, and again, I'm not going to go as in depth in this. I just want to kind of hit some highlights here and try to make people aware of this. And if you want to get the whole story on this, go watch that episode 207. I also have a link to this article in that episode if you want to go check it out. But this was released by Hudson Bay Capital. It was a paper called ATI, Activist Treasury Issuance and the Tug of War Over Monetary Policy. It's written by Stephen Mirren and Nouriel Roubini. Nouriel Roubini, obviously very famous for his book Black Swan. And I'll probably have to do a book review on that sometime soon, because it's an excellent book. But basically, what I'm going to do here is I'm going to skip down, and this was an incredibly written paper, just amazing. Like, you have to go back and read this. I just want to read this one excerpt here from the paper. So, whereas QE, quantitative easing, worked by removing interest rate risk from the market and hiding it away on the Fed's balance sheet, ATI works by limiting the production of interest rate risk at the source. The net effect, however, is similar. So similar to what the Fed was doing with QE. Now, they go down to a chart. Now, they have a chart here, comparison of QE and ATI side by side. So the transaction level is a little bit different. The portfolio balance channel is a little bit different. At the Fed, they're using their balance sheet. At the Treasury, they're reducing the creation of interest rate risk at the issuance of the Treasury bills. But here's where it gets very similar. The money supply channel again is just slightly different. The Fed is increasing money supply by creating bank reserves, whereas the Treasury prevents reductions in effective money supply because bills are a close substitute for bank reserves. However, the bond market effect, bond prices are higher than they otherwise would be, exactly the same. The risk asset effects, other asset prices are higher than they otherwise would be, exactly the same. Political economic framework. Now, they say the politically independent in principle central bank managing the business cycle via financial markets. However, with the ATI, it's politically dependent Treasury officials managing the business cycle via financial markets. So, in other words, what they're saying is that the ATI is a political tool as opposed to the QE, which was just a monetary tool being utilized by the Federal Reserve. Big distinction. Now, and then here's what's interesting. So they basically, and this is what I love about this paper, they anticipated the rebuttals and they put the rebuttals in at the end of the paper, which is fantastic. Because so how I became aware of this paper was from a feature article in CNBC, which basically asked, is the Treasury Reserve manipulating interest rates? And then they quote this article. And what was funny was a couple of the people that they tried to get comment from to discuss this article. This was the arguments that they immediately proposed. So here we go. So criticisms of the ATI view. So from the Fed, QT is not monetary policy. Okay, but they're still doing it nonetheless. From the Treasury, now here's where it gets good. So from the Treasury, issuance is in fact regular and predictable. The bill share, meaning T-bills, is only a few percentage points above 20%. The bill share has always varied over time. And focus on WAM, the weighted average maturity, not the bill share, and WAM is within historic norms. And what's funny is that is exactly what the person says in the article, kind of rebutting this, basically saying, oh yeah, well, everything's within norms, so there's nothing to worry about. But if you read this, they basically take all those arguments apart. And then finally, from the analysts, Wall Street analysts, why haven't markets priced in the terming out of excess bills? But that's coming. So now let's just take a quick look at the conclusion here. So, new issuance patterns by Treasury have deviated from regular and predictable auctions in a manner that exerts heavy influence on financial conditions and through them, the economy. We dub the use of varying issuance patterns for the sake of managing financial conditions activist Treasury issuance, or ATI. Drawing on a range of empirical economic studies of monetary policy, finance, and fiscal policy, we calculate that ATI has reduced long-term interest rates by about a quarter point, 25 basis points, providing similar economic accommodation as a full point reduction in the Fed's overnight policy rate. In other words, 100 basis point reduction from the Fed. So in other words, you would have to get, if the Fed cuts a quarter point in September, that's not even making a dent, because they would have to have a full point reduction in order to equate for the quarter point that the ATI has inflected in the economy. So combined with estimates of the neutral policy rate drifting higher, the joint stance of monetary and issuance policy is roughly neutral. The Fed isn't providing meaningful economic restriction, contributing to inflation persistence. It's the key thing there. However, we expect the surfeit of bills to be termed out. In other words, that was the question from the analysts. Why hasn't that been priced in? Eventually, the key word there, when the market starts to look forward to over $1 trillion of bills being termed out into notes and bonds, we expect it to temporarily raise long-term interest rates by 50 basis points, prompting a meaningful repricing of risk assets before settling back into, wait for it, a permanent 30 basis point increase. So in other words, what is this? What is, in layman's terms, what does this mean? So what it's saying is you have short-term T-bills, 3, 6, 9, 12-month T-bills. all of those T-bills are basically going to get termed out into longer bonds. They're going to get rolled over basically into longer bonds, your 10, your 20, your 30, your 15, your 20 or 30-year T-bills. And what they're saying is when that happens, they're expecting a temporary rise in the long term, the 10-year T-bill of 50 basis points, prompting a meaningful repricing of risk assets before settling back into a permanent 30 basis point increase. So what is the net effect of that? The net effect of that is that while the Federal Reserve is decreasing interest rates, you're going to have the 10-year Treasury going up, meaning that if, say, your residential mortgage rate right now is at 7%, well, guess what? As the Fed's cutting rates, that mortgage, that interest rate on that mortgage is not going to go anywhere. It's going to sit right there, or it might start to go down initially, but then it's going to jump back up. And people are going to be sitting there scratching their head going, why is this happening? Well, this is exactly why this is going to happen. So, and the net effect of that ultimately is that the decrease in interest rates will benefit commercial customers. It will benefit corporate debt, corporate bonds. It is not going to benefit the consumer. It's not going to benefit on the consumer side because all of the, your auto rate, your credit cards, your residential mortgage, they all run off of the 10-year T-bill. And so that's what's going to happen here. And then they conclude by saying the use of ATI to manage financial conditions and the economy into election season is a dangerous precedent that opens the door for material political business cycles in the United States. It threatens to raise long-run inflation and interest rates over time as future administrations make use of the same tool. In other words, this has become political, and the risk you run is that basically, administrations will go through the Treasury to use this tool to prop up the economy to get reelected, and then once they're reelected, they're going to pull back on this, and then maybe the economy takes a nosedive into a recession, and that plays out for a few years, and then they're right back to using this again when it's time to get reelected again. And that you just run the danger of basically putting us on this carousel, if you will, and getting it, basically totally distorting the economy. So frequent use of QE since the global financial crisis has shown a light on the eroding barrier between monetary and fiscal policy and opened the door for tools like ATI. The interaction between policy choices from the Fed and Treasury will remain a fruitful area of study for market participants, policymakers, and academics. So, if you go to my series that I did on the Lords of Easy Money, you will see that we talk about this whole debate between monetary and fiscal policy and how Congress over time has basically given up their fiscal policy responsibility and put more emphasis on the Fed and their monetary policy to, quote, fix the economy and bail us out. Congress they don't want to be basically responsible for what's going on. They want to put it all back on the Fed. Instead of it being a team effort between the government and the Federal Reserve working together to try to fix things. And we talk about that in the series, and we get into quantitative easing, the effects of that. So I highly recommend if you have not gone and looked at my entire series on the Lords of Easy Money, you need to go check that out. So, okay. So, and like I said, if you want more information on this, if you want the full coverage of this, go see the episode that I just did, 207. The Treasury is manipulating interest rates, and there's a link to this paper in there, and go check that out. So now, quickly, I want to show everybody this article. So this is U.S. banks log increased net charge-offs in several loan segments in the second quarter of 2024. So credit quality trends declined at U.S. banks with increased net charge-offs in several loan segments in the second quarter. So basically, let's take a look at some of these. So commercial and industrial, you could see here from the chart, you can see here that this is going up, which is not good because right now a lot of banks have changed their focus from, commercial real estate to C&I lending. So that's not a good trend at a time when banks are trying to focus more on that. Farm lending seems to be fine. Everything seems to be going okay there. Multifamily lending. Now, multifamily lending saw a tick up at the end of last year, and then it came back down, and now it's spiking back up again a little bit. So that's something to keep an eye 1 to 4 family, in other words, residential mortgages, it seems to be doing okay. Construction lending. So construction lending had a big spike up at the end of last year and has now been coming down. Now, I would suspect that the reason why this has been coming down is because banks have been tightening on their construction lending as far as underwriting criteria, existing loans. I mean, they're probably really tightening it up and making sure that the projects that are already in the pipeline are getting done and getting done correctly. And they're probably being a little stingier on new stuff that comes along. So, and now here's the two, probably the big ones at the moment, and that is credit card debt, which, as we see up here, the credit card net charge-off rate reached a multi-year high of 4.82% in the second quarter, 13 basis points up sequentially, and 134 basis points up year over year, which is a pretty big increase. And then we got auto loans here, which spiked up at the end of the year and have come down a little bit, but are still definitely at 0.99, almost 1%. I mean, that's still higher than what we're looking, than what you would ideally be looking for there. But I think moreover, though, what the more important grasp of this is that, like, what does this mean for the consumer and the economy? You have a time where savings are at an all-time low. You've got credit cards and auto loan debt is at an all-time high. Credit cards, I think, are at like I think are about 1.6 trillion. I think auto loans are like 1.2 trillion, something like that. You're starting to see massive delinquency now. I mean, the delinquency on credit cards is higher than it was in 2008 at kind of the peak of the financial crisis, which is a little unsettling there. So, and then you've got the whole buy now, pay later. I mean, billions of dollars have been put on to the buy now, pay later. And I think what that tells you is that basically the consumer is running out of gas. They're running out of money. They've maxed out the credit cards. They've maxed out buy now, pay later. And now the cracks are beginning to see. They've expunged all of their savings. And now the delinquency on credit cards and auto loans is starting to seep in, and then it will kind of roll from there. So very, so again, very kind of interesting things to point out there. Okay, I want to just get into a little bit of the news here for a moment. So let's switch gears here for a second, and let's go into a couple other things. So economic indicators. So what are some of the things that we got coming up next week? So on Monday, we've got durable goods orders coming out. We've got Atlanta Fed GDP Now numbers. On Tuesday, we got the consumer confidence. We got the 2-year Treasury note auction. We got the API weekly crude oil stock. We've got the 5-year Treasury note auction, and then we've got continuing jobless claims, initial jobless claims on Thursday, along with the GDP numbers, goods trade balance, pending home sales, 7-year Treasury note auction. And on Friday, we basically have core PCE price index, personal spending, Chicago PMI, Michigan consumer sentiment, and we got the U.S. Baker Hughes total rig count. So a lot of economic indicators, a lot of economic information coming out this week. Now, I think the key things that people will be keeping an eye on are obviously the Atlanta Fed GDP Now numbers on Monday, and then the official GDP numbers on Thursday, continuing jobless claims, initial jobless claims. So more of that labor market data, the GDP numbers, and then Friday, you've got the Fed's preferred inflation gauge, the PCE, the price index. So if all those things come in down, it's like, or if the jobless numbers are up, if PCE numbers are down, if GDP numbers are down, then obviously you're pretty much 110% assured of a Fed rate cut in September. But it will be interesting to see if we get any kind of curveballs here. If there's a PCE maybe spike back up, is the GDP. I mean, the GDP numbers for the first quarter were a lot stronger than what people thought, or what people thought was going to come in. But as we have seen with a lot of the economic data, what happens is we get this great headline number, and then the next month, the previous month's number gets revised downward, and then the new number gets plugged upwards. So it's kind of a very it's a troubling thing because, like, as I said in the episode where I talk about, the BLS and the job numbers and everything like that, it basically comes down to, well, what trust do we have in these numbers? I mean, if we can't trust the Fed that these numbers are right, then companies have to make business decisions on these numbers, and if they're not there, then how does this ultimately work out? So I'm just looking for something here real quick, and then I'm going to share this with everybody. So let's take a look at this for a second. So, and this goes right to the heart of what I was just talking about. So downward data revisions are the new normal. And we're going to use retail sales here in this example. So U.S. retail sales have been revised down in the last 7 out of 9 months. This year alone, 4 months of retail sales data have been adjusted down by 0.2 to 0.3%. In June, retail sales were revised down by 0.2 percentage points. First, the data comes in better than expected, showing the economy is on track for a soft landing. Then, the data is revised lower in the following month when attention has shifted to the new numbers. What is happening here? And you can see from this chart that, we got a couple up months, but most of the months here have been down. And this just goes to just goes to that whole point of, can we trust the numbers? Like, can we trust these numbers? And I think that is a legitimate question, and we have to keep asking that. So, okay, so let's get into, we'll come back to stuff in a second here. So let's get into some other news here for the moment. I just wanted to hit some things. So, okay. So the Federal Trade Commission had a rule to ban non-compete agreements. So, and that suffered its biggest setback yet Tuesday after a judge ordered a nationwide injunction. So Judge Ada Brown for the U.S. District Court of the Northern District of Texas said in a ruling that while the FTC had some authority in regards to a non-compete ban, it did not have the ability to enact such a rule without Congress. In sum, the court concludes that the FTC lacks statutory authority to promulgate the non-compete rule and that the rule is arbitrary and capricious. Thus, the FTC's promulgation of the rule is an unlawful agency action, Brown wrote in a court order. So we're going to have to keep an eye on that and see what's happening there. In other news, so TD Bank has not had a good couple of weeks here. So, so a couple weeks ago, TD posted a surprise loss as they anticipated fines from anti-money laundering investigations. So TD Bank shares fell after the bank reported a surprise loss for the third quarter of fiscal 2024. The net loss was driven by one-time expenses, including billions of dollars set aside for expected fines over investigations into anti-money laundering practices. And TD's earnings also missed estimates after adjusting for one-time expenses. So, and then TD also cut their Schwab stake. So TD also trimmed its stake in Charles Schwab during the quarter, selling about 40.5 million shares to reduce its stake to 10.1% from 12.3% previously. The bank said it has no current intention to sell more shares. So they probably were just selling shares to offset some of the losses they're anticipating from this anti-money laundering investigation. But then also, just a couple of days ago, they were fined $128.5 million in a texting probe over usage of chat apps. So TD Bank and 3 of its subsidiaries were fined a combined $128.5 million by federal regulators for using unapproved methods of communication to conduct business and for failing to maintain and preserve their employees' electronic communications. So, rough couple. We'll keep an eye on that, but a rough couple of weeks there for TD Bank. So. Here's another interesting story. I had reported on this I have a crypto series where I've done 8 crypto episodes, and I believe the last one I did on this. So, in Kansas, they had a bank called Heartland Tri-State Bank that failed last year. And it failed as a result of crypto, but not in the way that you might think. So Shan Haynes, the former CEO of Elkhart, Kansas-based Heartland Tri-State Bank, was sentenced to 293 months in prison, roughly 24 and a half years, for using his former position to embezzle tens of millions of dollars in a cryptocurrency scheme, which led the bank to fail at a complete loss of equity for investors. Haynes pled guilty to one count of embezzlement by a bank officer. And during his time as CEO of Heartland Tri-State Bank, Hines initiated 11 outgoing wire transfers between May of 2023 and July of 2023, totaling $47.1 million of funds to a cryptocurrency wallet and a cryptocurrency scheme referred to as pig butchering. The funds were transferred to multiple cryptocurrency accounts controlled by unidentified third parties. Haynes' actions caused the Heartland Tri-State Bank to fail and the bank investors to lose $9 million, as stated in the news release by the U.S. Attorney's Office, District of Kansas, on August 19th. Now, there were a couple interesting things about this story real quick. So the first one was when the bank failed, the regulators and the U.S. Attorney's Department were very tight-lipped about what was going on here and why this bank had failed. And it took a number of months as stuff began to kind of leak out. American Banker had an article on it. They kind of said, we think this guy was embezzling money. But then slowly this whole kind of crypto aspect of this thing came out. Now, I think it's important to note, and I did a whole episode covering what pig butchering is. And that's a very crude term, but basically what it means is like you fatten the pig before you slaughter it. And a lot of times what pig butchering is people, they start to form relationships over like dating websites. They do different things, and basically they try to get you to hand them over money. Maybe they give you some sob story. Maybe maybe blackmail is involved, but they try to do these different things to try to get you, to suck you in, to give you, to get money out of you. So this was not a case like FTX where the CEO had, like, say he had bet on crypto through FTX, through the exchange, and the bet went wrong, and now he effectively got like a margin call and he had to cover the bet, and so he embezzled the money from the bank to cover that bet. That does not appear to be the case of what happened here. What appears to be happened is he got sucked into something, and then he put that money, he was instructed to embezzle that money and put it into a crypto account, which other unidentified third parties had control over, and then ultimately whether or not they've been able to recover any of this money, we do not know. Who these third parties were, we do not know. And it'll be interesting to see what the whole tale is here. Like, in other words, did this guy, and again, I'm just purely speculating here, did this gentleman get sucked into some kind of like, OnlyFans type thing where maybe somebody was blackmailing him and he felt like he had to do this to try to like save his career, and maybe he got forced into it. And again, I don't know how embezzling $47 million and ruining the bank was going to save you. So I'm not sure if I follow the logic there, if that's in fact what it was. But again, it was an interesting story, and it covered kind of crypto fraud from a different angle. And that's why I found it interesting and wanted to look into it. And I also just thought it was puzzling that the regulators in the U.S. Attorney's Office were just kind of so slow to leak out details of what happened here. And like I said, we still have a lot of unanswered questions here. Like what, did this guy get sucked into something? Was it blackmail? What was it something else? Like, what was it? But I have a feeling, we will find out. Maybe this guy writes a book or something someday. He writes his tell-all or something like that. So I don't know. But like I said, I just thought it was an interesting article. So let's go into a couple other things here real quick. I wanted to talk about this for a second because I wanted to give a shout out to one of the listeners. At Night Trade 24. This is for you. So I did an episode last week on how the FHFA is changing the credit scores as part of the underwriting for residential mortgage loans. They want to change from what's called the classic FICO credit scoring model. They want to go what's called to the FICO 10T and to the Vantage Point 4.0 credit scoring models. And one of the questions that I got from Night Trade 24 was, can I do an episode on the FHFA conservatorship over Fannie Mae and Freddie Mac and specifically address how it happened, why it happened, and what's the outlook. So I think that is absolutely a fantastic topic. I think that I will absolutely do an episode on that and check into that and see what we can do there in terms of telling that story and hopefully telling it in a good way. But I think there absolutely needs to be a conversation around that, because these, Fannie Mae and Freddie Mac should not be in conservatorship anymore. I mean, they've been in there since 2008. And so we'll get, so like I said, episode coming on that. And I really thank Night Trade 24. And I would also suggest to anybody else, if you've got topics or things you want to see covered, please, send me a message, and I would be happy to cover those. You can also email me at info@thebankernextdoor.com. That's a great way to contact me as well. So, and the reason why I bring that up is because I have an article here that basically says the FHFA proposes housing goals for Fannie and Freddie Mac for 25 and 27. So they're just basically saying they want them to responsibly promote equitable access to affordable housing and reaches low and moderate income families, minority communities, and other underserved populations. So there you go. Existing home sales increased in July. The CSBS establishes an AI advisory group. So the Conference of State Bank Supervisors created an advisory group to provide perspective to CSBS and state financial supervisors on the development and use of artificial intelligence in the financial services sector. So that's interesting. Consumer prices rise in July. Producer prices rise 0.1% in July. Small business optimism rises. Retail sales, industrial production fall. The ICBA calls out the FHFA for overstepping with the Federal Home Loan Bank inquiry. We'll keep an eye on that. ICBA is also asking the FDIC to withdraw their brokered deposits proposal. I did an episode on that about a week or so ago, so everybody should check that out. Let's see here. Rural Economic Index declines. Is anything else here? I kind of covered that. A lot of other stuff in here, but I'll get into that later. Okay, I've got kind of one more thing I want to cover here before we wrap up. So let's take a look at this. I thought this was a fascinating story. So what we know about the super yacht sinking off the coast of Italy. So the bodies of British tech tycoon, a Morgan Stanley executive, and 5 others, including a teenager, have been recovered after the super yacht Bayesian sank off the coast of Sicily on August 19th. So what happened, and how could such a huge vessel suddenly go down within sight of the shore? So just to kind of fast forward. So Mike Lynch was the founder and former CEO of software firm Autonomy. Now, Autonomy, years ago, back in 2011, so basically he was just recently cleared of defrauding Hewlett-Packard from when he sold Autonomy, the software company he co-founded, to the U.S. computer giant in an $11 billion deal in 2011. And literally within months of Hewlett-Packard buying Autonomy, they literally had to write it down to zero. I mean, literally take a total write-off on $11 billion. This guy's been in court for the last, 14 years here trying to do something. And then very strangely, out of nowhere, like a week or so ago, all of the charges just were dropped. Okay. So he was now in the clear. Then mysteriously, his co-defendant in the fraud trial, 52-year-old Stephen Chamberlain, he died after being hit by a vehicle while out running in Cambridgeshire, England on August 17th. And Chamberlain was also cleared of any wrongdoing. So, it's just like I said. I mean, I am a person that I do not believe in coincidence, and I do not believe that these guys. This seems awful crazy. Awful crazy that this guy got cleared of these charges, and then his partner gets hit by a hit and run, killed, and then 2 days later, this guy's on his boat, like just off of the shore. And I just want to show you this to you. So here's kind of an image of the storm here, and it gets crazy like this. Like it was the ocean, everything was completely calm, and then out of nowhere, this bizarre storm blasts these guys so hard that it capsizes the boat. And here's kind of an image of the boat here, but then here you see like this thing was the sail on this thing was enormous, 246 feet, and it had these lights on it at nighttime that they could see from way out. There was another boat. There was another yacht that was close by that basically said that they saw the lights from the sail, and then literally like 5 minutes later, all the lights were gone, and they were able to go over, I think, and pick up some of the people, and then they I think they did send out like a mayday, which basically, but it's just like I said, this is just a crazy story, that I found so fascinating. Like that these guys just get cleared of charges, and they both just happen to die in these kind of really freaky, mysterious ways, just days apart. Yeah, I don't know. So more to come with that. So I would just wrap up with just by saying, like, hey, look, I've put out a lot of really good episodes the last couple weeks, and I would tell everybody to go check out some of that content, and please make sure to like, share, and subscribe, as it always helps the channel. Please remember that we are on YouTube, Rumble, and all major podcast platforms, so please check us out, whatever medium is that you like the best. And like I said, please let me know. I mean, if you have anything that you want me to cover, or things that you feel like I haven't covered here yet on the channel, please let me know. I would be happy to do that. And like I said, just to wrap up, what am I thinking of in the end here? So, I just want to say, like, I am going to be kind of experimenting with these live streams. So there's kind of two things happening here. The first thing is that I have been doing for a year now the weekly banking update, which was just a 30-minute episode that I was putting out generally pretty much every Sunday, where I was just trying to cover banking news and kind of give you as much as I could in a 30-minute time span. So I'm kind of I'm transitioning that weekly banking update into the strategy room, which is going to be a live show going forward. I'm hoping to do this live show every week. So we're making that transition, but then also I'm going to experiment over the next couple months with when I should do the show. Like I would like to do this on Sundays, but I'm thinking that Sundays during football season is probably not gonna work real well. So I think I'm gonna try this on Friday night and on Saturday night, and somewhere in the area between like probably 6 and 8 on Friday and like 6 and 8 on Saturday, and probably try that for a few weeks or for a month or two, and just kind of see how that goes. And then kind of take it from there. So, but yeah, just like I said, I'll keep everybody updated on things that go. A lot of episodes coming out. I've got basically 10 episodes right now on the docket that I'm on, different topics and things that I'm working on, and I have a couple other big announcements for a couple of special series that I'm going to be rolling out here over the next year. I'm going to be doing kind of a historical series. I'll have a co-host on that when I do that. So that I'm hoping people will enjoy that. Obviously got more interviews coming up in the next few weeks. So keep an eye out for some of that. I think I have some pretty interesting ones coming up. Different companies, different products, different banks, different things like that. So keep an eye out for that. And like I said, hope everybody enjoyed this, and I will hope to see everybody again real soon. So enjoy the rest of your weekend. All right. See you later, everybody.